What I'd like to do first is one, the Excel review. The Excel review closes Friday at 3. A lot of you still haven't done it. Okay, and there's no extensions on that one. It's been out there a long time. Also, tonight, Connect Homework number 1. Connect Homework 1 opens at 9 p.m. tonight. It's due February 8th at 3 p.m. You have 3 attempts to do it. It covers the chapters we'll have through tonight. Yeah? That's extra credit. You are also, with the Excel review, you got to remember, at least one of the Connect Homework each one of the Connect Homework assignments has at least one Excel type question. So if you're not comfortable with Excel, that's a way to get some practice and some extra credit. You can do it more than once. And you, again, if you go through an iteration, the next iteration, it'll only prompt you for what you didn't get right the first time. Now, okay. What I want to do first is go over our in-class exercise from the last time. Okay. Now, first thing you were asked to do, you're given some facts, and you were asked to compute some ratios. Okay. So, for example, the quick ratio and the would be strictly driven by the balance sheet in the back, where you take current assets minus inventory and divide it by current liabilities across the 2 years. Okay. Days in inventory, you would have taken cost of goods sold, divided it by inventory, and then divided that into 365. Day sales and receivable, you'd have taken sales, divided by that by accounts receivable to get the turn, and divided that into 365. Okay. Total debt ratio would have been total liabilities divided by assets. Debt to equity ratio would have been total liabilities divided by stockholders' equity, okay, and so forth. The solution is posted in Canvas. Okay, but these are basically the numbers. The one probably some people sometimes have problems with is the price to earnings ratio. To do the PE ratio, you first have to compute earnings per share. And you're given up above that there's 400,000 shares of stock outstanding. Earnings per share is net income Earnings per share is net income divided by the 400,000 shares outstanding. And I have this down below. Then you divide that into the price, and you get the PE ratio, okay, which is 3.2 and 2.8. The common size financial statement, you're asked to do a common size income statement. You basically are taking every line item of that income statement as a percentage of sales. So cost of goods sold, you would take the 8.2 million cost of goods sold, divide that by the 11,500,000 sales, and you get 71.3%. That's in 2012. In 2011, you take the 7,684,000 divided by the sales of 10.7 million and turn it into a percent. Now, 3 is a common DuPont identity question. If you remember, the DuPont identity says the return on equity is equal to the return on assets divided by the equity multiplier. But you're not given the equity multiplier, you're given the debt to equity ratio. And last time we saw the relationship is the equity multiplier is the debt to equity ratio plus 1. You're given the ROA, so you have 2 of the 3 pieces you can solve for the third. And that was essentially in class exercise 3. Questions? Chapter 18 and Chapter 4 have one thing in common, financial planning. But Chapter 18 deals with it on a short-term basis. Chapter 4 more on a long-term basis. Okay? So in Chapter 18, we're focused on working capital. If you remember, working capital is current assets and current liabilities. In the typical business, you have some kind of an operating cycle, which is you acquire some inventory, okay? And then you sell that inventory, and you end up with receivables, and then you receive cash from the customer. The problem is, in this situation, you tend to have a gap between when the firm pays out to the supplier for what they purchased and when they receive cash from the customer. So from the point of view of this analysis, current assets are the non-cash current assets. Current liabilities are things like payables and accruals, so forth. And we said last time current assets or working capital is, you like to have a positive working capital where your current assets exceed your current liabilities. At the same time, it's an investment in the business. You've invested in receivables, you've invested in inventory, okay, that you may have had to pay for. Yep. What's that? Okay, working capital cycles. We're going to use Chapter 3 ratios to come up with these cycles. Okay, but the thing to keep in mind is because when inventory and receivables exceeds payables, you're using up cash, and there ends up being a gap there. So from the point of view of the manufacturer, the operating cycle is from the arrival of the raw materials until the business is paid by the customer. If it's a merchandiser, it would be from the point the merchandise inventory shows up. The cash cycle is that portion of that where the firm has already paid the suppliers, but they haven't been paid by the customer. A subset of that operating cycle is the cash cycle. So the way to look at this is the total, that total period there, which is called the stock conversion period and the debtor conversion period, is the operating cycle. And then if you back off the accounts payable cycle time period, you end up with the cash cycle. And there's a gap there from the point they pay the supplier until they're paid by the customer. Okay. So we're going to use the 3 ratios we saw last time: the days in inventory, the average payment period, and the day sales and receivables to compute both the operating cycle and the cash cycle. So the days in inventory for the purpose of this class, since we're only going to be doing it for merchandisers, is going to be, you're going to take the cost of goods sold, divide it by inventory to come up with the turn, and divide the turn into 365. The debtor conversion period is the day sales and receivable, which is sales divided by receivables, and that divided into 365. That's our total operating cycle. Subtract out the average payment period, which we also saw last time. that leaves us with the cash cycle. So again, the sum of the two there is the operating cycle. Back out the average payment period, and you're left with the cash cycle. In terms of formulas, again, the operating cycle, days in inventory plus days sales and receivable. Take the operating cycle, subtract the average payment period, you have the cash cycle. So what happens is, if a firm's inventory keeps growing and growing and growing, all other things being equal, the cash cycle is going to get longer. Days sales and receivable, it grows, the cash cycle gets longer. If the cash cycle is too long, you can have a profitable firm that can become insolvent. Why? Inventory is not an expense. It's on the books as an asset. Receivables are on the books as an asset unless they go bad. Okay. So the firm can look profitable, but they're simply running out of cash because they're not collecting cash as fast as they're paying it out. Where this is most highlighted would be in your statement of cash flows. You would see big outflows in those areas for inventory and receivables, and not enough of an inflow from payables. Okay, so what I want to do is take a moment and show you an example from the statement of cash flows. So this example here, or this example here, not the statement of cash flows, but from the case of the ratios, specifically what this can mean. So let me So I've got here the three ratios. So I'm going to do the inventory turn. I'm going to say it's the cost of goods sold divided by inventory. So I've got two inventory turns for the 2 years. I'm going to take that and divide it into 365. So what happened? Over the 2 years, days in inventory went from 95 days to 133 days. The accounts receivable turn is net sales divided by receivables. Okay, receivables went up from about 55 days to 63 days. So at the same time, payables went up from about 36 days to 44, 45 days. The operating cycle is going to be days in inventory plus days sales and receivable. And at this point, you've got an operating cycle which is gone up from 150 days to almost 200 days. And then you compute a cash cycle of 114 days to 150 days, almost half the year. Now look what happened to this firm. You have a firm that was profitable, sales grew, but cash remained essentially flat. Okay. How did cash remain flat with that cash cycle growing so much? Well, then you look, and what you see is here, that they took out $1 million of notes, short-term notes payable, to prop up the cash balance because they weren't collecting cash as fast as they were paying it out. That's what happened. Small businesses, the owners get over-aggressive, try and grow the business too quickly, and begin burning up all their cash. And eventually, creditors are going to cut you off if your debt keeps going up and up relative to your assets. Questions? This is why this type of short-term liquidity is important. Yeah. So how can we manage this? Well, one, in this day and age, we have just-in-time inventory. You can reduce that days in inventory. You can accept credit cards instead of having receivables, keeping in mind that that discount rate that we talked about in Accounting 211 is a significant cost of money. Or you can take current liabilities to fund current assets, such as paying your suppliers on the last day. But you can't grow your liabilities indefinitely relative to your total asset base. You'll see this again in things like supply chain. When you invest in current assets, any current asset, whether it's inventory or whether it's receivables, you have carrying costs and you have shortage costs. And as a business person, a financial manager, you need to trade them off to find the optimal amount for your business. Okay. Carrying costs, if you have a lot of these current assets, you have capital tied up and it's not earning a return, or if it is, it's a small return, plus the explicit costs, such as things like for inventory, insurance, warehousing costs for receivables, AR collection and costs, and bad debt expense. Let's say you have a very tight credit policy, you loop in your receivables, that's a shortage cost, you'd have lost sales. Also, if you don't carry enough inventory, you could have lost sales from stock out, lack of selection. If you're carrying small amounts of current assets, like you're doing a lot of frequent small volume purchases, there's a lot of costs there. It could be emergency shipping costs. When you look at this, the carrying costs go up with the amount of current assets. The shortage costs go down. The total cost looks sort of horseshoe shaped, and there's an optimum point, and it could vary by firm, but every firm has just the optimum amount of current assets. When it comes to managing your cash reserves, how much cash should you carry? Okay. Well, again, there's a trade-off. High cash reserves, not likely you'll have financial distress. You'll be able to deal with emergencies and maybe take advantage of unexpected opportunities like a good buy on some inventory at a discount. But you have to keep in mind that cash earns no return. Short-term marketable securities earns a very small return. Okay. So that you have to trade that off. One of the things we do know is for over the last 30 years, firms seem to be holding more and more cash and taking on lower levels of debt. Second thing is when you look at the right side of the balance sheet and how you finance, you could have short-term debt, long-term debt, or equities. On the same side, on the left side of the balance sheet, you have current assets and long-term assets. Generally, the maturity of the funding should match the lifespan of the asset. So typically, you're going to fund short-term assets with short-term financing and long-term assets, long-term financing. Okay. So typically, you would do temporary current assets with trade payables and short-term debt, permanent or long-term assets and fixed assets with either long-term debt or equity. Another factor are interest rates. Typically, short-term debt has a lower interest rate than long-term debt. The risk is rates can change. Also, you might not be able to roll the debt over if you need to. Example, the financial crisis. Now, this general relationship of short-term debt having lower interest rates than long-term debt is what we call a normal yield curve. And we'll see this when we get to the back end of the class. Sometimes we have this thing called an inverted yield curve in certain situations where the long-term debt rates actually drop below the current short-term rate. So why do we need cash? Well, we need some cash on hand to pay our routine transactions due to the cash cycle, paying bills, wages, taxes. Also, when you have a credit line at the bank, they may require what's called a compensating balance, that you keep a portion of that in the bank account. And finally, you want some reserves for opportunities that may come along. And this may vary by business. The length of the cash cycle, okay? The nature of the expense structure, is it highly fixed? A lot of operating leverage? Is it variable? Is there a lot of financial leverage? Okay, that's really chapter 18. Any questions? In terms of the in-class, what might show up on an exam from chapter 18 are questions on operating cycle and cash cycle. So what are you going to do? The three ratios you already know from chapter 3, you'll be using them in chapter 18 to determine the operating cycle and the cash cycle. Chapter 4 differs from chapter 18 in that now we look at long-term planning and growth. We're going to see that there's a growth rate that a firm can have, and by staying within that growth rate, limit their requirements for external finance. But as I mentioned, a lot of times businesses get into trouble because entrepreneurs really want to grow the business. They grow too aggressively. They grow faster than their growth rates they can sustain, and they begin consuming the requirements for external finance. Debt or equity keeps climbing, and then they get into trouble. Long-term planning is in three categories. Investing in long-term assets, which is typically called capital budgeting. Whether you're going to fund with debt or equity, which is capital structure, and what we pay out to the shareholders, which is dividend policy. So planning horizons, they can be short-term, and typically, if it's for a year, it's a budget. Longer than that, it's a business plan. Keep in mind, when you do a business plan, the first year of the business plan is going to be pretty much given your budget. So they're not mutually independent. And your business plan will be what are called pro forma financial statements, forecasted financial statements. Typically, you have a capital investment plan and a long-term financing plan. Are you going to fund with debt or short-term debt, long-term debt, or equity? When you're doing these plans, one, they need to be realistic. You can't assume optimal conditions. Things will go wrong. They have to be consistent. If you're going to do a forecasted balance sheet, that accounting identity of assets equal liabilities plus equity still has to hold. The net income plus minus any dividends in your plan has to equal the change in the equity section of the balance sheet. Just the same rules have to apply. You walk into a meeting where things don't tie and you end up looking like with egg, you end up with egg on your face. They'll cut you to ribbons. The other thing is you have to think through interactions. If I'm launching a new product, is it going to eat into sales of an existing product? And these synergies can be positive and negative. And if you set this up correctly in Excel, you can do a variety of scenarios. How robust are yours? Is your what you're coming up with to changes in the assumptions? The start point is the sales forecast. And an important part of that is the growth rate. Now, most companies have a variety of products and they have to do this individually and aggregate it. In the examples we're going to see, we're going to have just a flat sales growth rate of the sales in dollars. Keeping in mind that your cash flows depend upon sales. From there, you can come up with pro forma statements, which are a balance sheet, an income statement, and a statement of cash flow. The examples we're going to see are really, really simple. Okay. Normally, part of developing these models is you have to look at economic situations, like what's the inflation rate? Because your sales are going to grow not only because you've increased your market, but also because the value of the dollar has gone up. There's the state of the economy, which typically would be like the gross national product. If you have a product that requires financing, your customers are going to be impacted by fluctuations in interest rates. When it comes to doing a forecasted balance sheet, typically what we're going to have to do is we have to develop our projections for our assets and then figure out what's the right way we're going to finance them. So we'll do the asset side of the balance sheet first, the liability and equity side second. So we need assets that are required to meet the sales forecast. If sales go up, then likely receivables are going to go up and inventory are going to go up. And that'll increase our requirements for assets and increase our requirement to fund the assets. When you do this in a balance sheet, in the end, one variable is going to be a plug that you back into to make the accounting identity of assets equal liabilities plus equities work. Okay, so this is a real super simple example. We have a firm that had $2,000 of sales, $1,600 of costs, and $400 of net income, and $1,000 of assets and $1,000 of liabilities and equities split as you see. This is the historicals, and we're going to do the forecast for the next year. So let's assume revenues grew at 15%. So now your 2,000 is 2,300. Our relationship between expenses and sales is constant, which means expenses grew at 15%. We're going to assume the assets grew at 15%, the liabilities grew at 15%, and the equities grew at 15%. Okay, so look at this now. Over on the right is the income statement. The forecasted income statement is $2,300 of sales, $1,840 of expenses, and net income of $460. Okay. Assets grew by 15%, which means total assets from 2012 has to equal total liabilities and equities in 2012. Debt and stockholders' equity each grew at 15%. But notice, total stockholders' equity went from 600 to 690. Net income was 460. For that to work, it means the firm must have paid out 370 in dividends. And in this case, dividends was the plug. Because remember, your ending retained earnings has to equal beginning retained earnings plus net income minus dividends. And so if stockholders' equity went up by 90, then ultimately the difference between net income and that increase has to be your dividends to make it work. Questions? So the way I look at this is when you're doing these things, work on the left side, come up with the assets, and your total assets has to equal total liabilities plus equities, then start filling in the buckets on the right. Another example, revenues grew at 15%, expenses by 15%, assets grew by 15%, equities grew by 15%, no dividends were paid. Notice it's not saying anything about debt. That means debt is the plug. Okay? So again, if net income was 460 and no dividends were paid, then total stockholders' equity has to go up by 460. So what happens is we take total liabilities and equities and we back out stockholders' equity to come up with debt of 90. And therefore, in this forecast, the firm is paying off debt of 310. Notice that in forecast, the basic rules of accounting still have to apply. And so oftentimes I see students doing pro formas where the assets don't equal the liabilities plus equities. That's the first basic thing you have to remember. That identity still has to hold. Okay. Common approach, percentage of sales, where income statement, we look at historic relationships of expenses to sales. And that's where that common size income statement is useful because it gives you that history. Some costs may not vary with sales, such as depreciation and interest expense. Also, what may not vary with sales is dividends. There's a saying about dividends. Dividends are sticky. In other words, firms don't want to raise the dividend unless they know they won't have to cut it. So dividends, because they're by management discretion, typically won't vary with sales. Typically, what we somewhat assume is dividends are some percentage of net income. That's what's called the dividend payout ratio. Okay. So let's look at a new example. Sales grow at 10%. Expenses are a constant percentage of sales. We have a dividend payout of 50%. Now, what I call the retention ratio, your author calls the plowback ratio. That is the amount of income you retain and reinvest in the business, plow back into the business, so to speak. In our balance sheet, assets will be based on a percentage relationship with sales. Accounts payable varies with sales. We're going to assume debt remains constant, common stock remains constant. Therefore, retained earnings is driven by net income and dividends. So if you look at this, here's what happens. Okay, historically, cash is 10% of sales. As sales goes up by 10%, cash goes up by 10%, from 500 to 550 and so forth. So first we grow the sales, we maintain our historical relationship for expenses to compute our earnings before taxes. Income taxes, we use a historical percentage. And remember, 50% of our income is paid out as dividends. The remainder gets transferred to retained earnings. Okay. All our assets are growing based on the historical percentage of sales. As the sales increase from 5,000 to 5,500, all these assets grow, and we end up with assets of 10,450. Now, if we don't back into something, here's what's going to happen. Accounts payable is because we're maintaining the 18% of sales, accounts payable grows. We've said no new notes, no new long-term debt. So this adds up to 5,490. No new common stock, and retained earnings increases by 660 from 2,100 to 2,760. Look what happens. The right side of the balance sheet is 200 less than the left side of the balance sheet. Why? The firm grew at a rate it could not fund internal. It needs some kind of external finance, whether it's debt or equity, because of the rate they grew. That 10% growth rate went beyond what it could fund internally. So what are our alternatives? Short-term debt, long-term debt, sell some stock, or cut the dividend payout, which is usually not popular with the shareholders, or if it's a publicly traded firm, with the market. Announcement of a dividend cut or elimination, guaranteed the stock price is going to fall. Because the market looks upon that as bad, as a signal of bad news. So our sales growth can't exceed our asset capacity. We need to, therefore, if we grow at a certain rate, we're going to have to acquire additional assets, and the assets are going to require funding. And they may require external funding, depending upon how much we're growing. Okay. Internal financing is funding out of retained earnings. And you can grow at moderate levels and fund internally. But at higher growth levels, you're going to have to get external finance. And then the choice for a financial manager or an entrepreneur is debt or equity. And the trade-offs are debt, the interest is deductible, it's a fixed obligation, but you run the risk of increased financial distress. Equity, you dilute the ownership interest, and dividends are not deductible. This relationship of growth and external financing is important from the point of view, it's where a lot of small businesses get into trouble. They try and grow too quickly, then they have to maintain their liquidity with external finance, typically debt, and they increase the risk of insolvency. And this is a reminder, finance, there can be two different ways of saying, or more of saying anything. Retention ratio and plowback ratio are the same thing. Okay. There's two formulas that help us understand what level we can grow at, the internal growth rate and the sustainable growth rate. The internal growth rate is the rate we can grow entirely on internal finance. In other words, how we can grow from our retained earnings. And so you have to use that return on assets we talked about last time, multiply it by that retention or plowback ratio, and divide that by 1 minus that product of the return on assets minus the retention ratio. So looking at an example, if the dividend payout is 50%, the retention or plowback ratio is 50%, And in the example, ROA is 0.1263. You need to do this in decimal. Okay? So we're going to take the 0.1263 times the retention ratio, divide that by 1 minus that, and we come up with 6.74%. If you grow no more than 6.74%, you will require no additional external finance. Beyond that, you will. If you're staying within that internal growth rate, your total debt ratio and your debt to equity ratio and your equity multiplier will all decline over time because equity is increasing in relationship to debt. If you have a target capital structure, you want to grow where you're trying to maintain a constant debt ratio, you would want to try and grow at a level where the amount of debt you're incurring is consistent with the growth in the asset. This is where the sustainable growth rate helps us. The sustainable growth rate is that upper bound on how fast you can grow and not increase your total debt ratio. The assumption behind it is you're not issuing any new equity. You're only going to fund with debt. And based on that, that sustainable growth rate, if it's 10%, if you're growing at 10%, you'll be taking on additional debt, but the rate it grows will match the growth in the assets. The debt ratio will remain constant. The formula looks a lot like the internal growth rate, except that instead of using ROA, we're going to use ROE, return on equity. So if you remember the DuPont identity, that the ROE is equal to the profit margin times the total asset turnover times the equity multiplier, our sustainable growth rate is impacted by our profit margin, which is essentially our operating efficiency, revenues and expenses, total asset turnover, which is asset efficiency, and our use of financial leverage, plus what we retain versus what we pay out as dividends. So a firm that has a higher retention ratio will have a higher sustainable growth rate, all other things being equal, which is why growth firms tend to pay little or no dividends. So they have a high retention ratio, they reinvest it in the business. So again, the sustainable growth rate, instead of ROA, we're plugging in ROE. Using the same example, the firm has a 17.14% sustainable growth rate. Up to that level, if they're growing if they're growing more than the internal growth rate, which we saw previously, but are staying within the sustainable growth rate, debt will go up, but the total debt ratio won't. Once they go over 17.14%, their debt ratio will increase if they're funding exclusively with debt. In doing these type of forecasts, things you have to keep in mind is something I mentioned before, agency costs. The conflict in publicly traded firm, the conflict between the outside shareholders and the inside managers. A good example in budgeting, it's common, ask for more than what you need to try and ensure you get what you need. Manipulate compensation to manipulate the budget to maximize your personal compensation, such as if ROA, return on assets, is part of the compensation scheme, you can manipulate that with the plan. Now, keep in mind that in this day and age, it's common for firms to use stock options as the form of motivational compensation to avoid this. Okay, so let's go back and look at an example here. Here's the plan we were talking about before. Okay, and look at this. This firm was growing at 10%. The internal growth rate was 6.74%. The sustainable growth rate was at 17.14%. Because they were growing more than 6.74, they needed 200 of external finance, which we show here. But they were still operating below the sustainable growth rate. So when you look at what happened to the debt ratio, it actually went down, even though debt went up. Questions? Okay, that is really chapters 18 and 4. And what is going to be on, what you have to look for the exam 2 weeks from tonight is, again, questions on cycles, and you're going to get asked to do a simple pro forma. So the in-class exercise we're doing tonight is going to be a good practice for what's going to show up in that exam. So I'm going to hand out the in-class exercise, and then I want you to take a moment before you start, because I want to give you some guidance on it. Okay, this is the exercise. The first one is really easy. I mean, you're given the days in inventory, the day sales and receivable, and the average payment period. You need to figure the operating cycle and the cash cycle. Then, down below, number 2, you're given a ROA, an ROE, and a payout ratio. Remember, the formula is based on the retention ratio, not the payout ratio. You need to compute the 2 growth rates. Then you're asked to do a pro forma. Okay, look at the facts you're given. You're given sales are projected to grow at 25%. Okay, you're given a lot of other things. But the thing is, you've already been given a completed income statement. I did the income statement for you. Okay? But you need to use this. And what you need to use is the transfer to retained earnings. Then over here, I've also done the asset side of the balance sheet. What you need to fill in are these shaded areas here to make this work. And the thing to keep in mind, it tells you here, long-term, always look for this in one of these, long-term debt is the plug variable. You're backing into long-term debt. Okay? Any questions? Go ahead.